Okay, we'll go ahead and get started. Tonight, well, actually, there's one thing I want to talk about before I do anything. And that is to sync your grades up from the My Business course into Blackboard. You have to first click on the My Business course link at least once. And I'll show you what I mean by it. So if you go into, oops. So if you go into Blackboard and go to My Business course link, and you have to click on this at least once and sign in. And that will connect your grades. You'll sync your grades up with the Blackboard account. So now you only have to do it once. So like I say, if you want to keep going to the website without going through Blackboard, that's fine. But you have to click on this at least once, or else the grades from Blackboard won't go. Any question there? Okay. Oops. Okay, today we have two handouts to do, but I want to talk a little bit if we ever get to a problem, and I think today we might do one of the problems in My Business course for the statement of cash flow, just because it's harder. But if you guys ever want to meet and go over homework problems, we can do that too. There's no problem with doing it, and we can even put in a second meeting day of the week. The only day I can't meet on is Thursday. I have another class on Thursday at 6, but we could do it other times too. So if you have any other times you want to do the work on, if you want to going over the actual problems in My Business course, we can do that too. Okay, today we're going to start off with chapter 3, and yeah, statement of cash flow. There's actually a little bit of other stuff in there too, but let's go ahead and click on that. The first one's pretty easy. And earnings per share. And by the way, you got these Excel handouts that you can use these when you're taking the test or doing the homework. So, yeah. All right. Earnings per share. One of the things that they talk about a lot of times is, for businesses, is how much earnings do they have per share. It's a big number. And it's basically how much net income do they have for each share. And so here we have Thompson Corporation. And basically you just put their earnings or their income. This is just net income. And you divide it by the number of shares. Now they have 20,000 shares of stock outstanding. So we'll put 20,000 in here. And so it comes out to be $6 per share. So this is our earnings per share. Okay, now down here, this is what they call a diluted or fully diluted earnings per share. And you'll notice down here that these employees have $5,000 of shares that they can buy. They can buy them at $80 per share. And you'll notice if this stock is selling at $90 per share, it might be worthwhile for these employees to buy them at 80 and then sell them at 90. Okay? So it's somewhat likely that they're going to do just that. They're going to buy 5,000 of these common stock shares. So the earnings will be the same. But the shares will be the original 20,000 plus the 5,000 that are likely to be exercised. Covering up my stuff here. There we go. So there's 25,000. Yeah, so this is fully diluted. So this is the outstanding stock. And these are the options that people could call exercise. And so if they exercise these options, well, the earnings per share goes down. So this is the fully diluted or diluted earnings per share. And you'll see that sometimes you look at a company's financial statements, they'll say, here's the earnings per share and here's the diluted amount. And the diluted amount says, okay, if everybody exercises these options, what would it be? All right, now I'm not exactly sure why they have this in in this chapter, but they do. So that's the way it goes. Now, for the really hard part, statement of cash flows. All right, statement of cash flows. This is a statement that basically tells you what happened to the cash. I know it sounds strange, but companies actually don't necessarily live on making income, right? Give me 1 second here. Do something. About that, there's a fan that was bothering me. Companies don't really live on net income. They live on cash, and cash is like blood. And it may sound strange, but companies go bankrupt because they run out of cash, not because they're having losses. You can have losses as long as you keep the cash coming. So, you know, cash is the main thing. And by the way, there have been profitable companies that have gone bankrupt. Even though they're profitable, they ran out of cash. And a lot of times for companies that are expanding too fast or something like that, it does happen sometimes. For instance, let's say that you have a store that's doing very well. Well, you might get the idea, well, let's open up more stores, right? I mean, I figured this out, so let's go to the next step and do this, replicate this, right? If you do that too fast, you can definitely run out of cash. For instance, let's say you say, okay, I get this one store, I'm going to open up 3 more stores. We have a total of 4 stores, 3 more. But when you open up those new stores, what they need, you got to get, the land, the lease and all, or whatever that is. You got to get all the stuff into the store. You got to get all the merchandise into the store. You got to hire all the people. You got all these costs going out before anything comes in. And sometimes if a company expands too quickly, they can actually go bankrupt, even though they have a great plan and a great way of running a business. If they don't plan on the cash, they can go bankrupt. All right, so that's what this statement of cash flow is all about. So we have our income statement from last time, statement of retained earnings, and the balance sheet. And now this fourth statement is kind of a new one. Those first 3, the income statement, statement of retained earnings, balance sheet, those have been around for 400 plus years. You can look at, books from the 1500s, and they don't look that different than what we have today. But the statement of cash flow is a fairly new one. It's 40 years old or something like that, which is still old, but I mean, it's not 400 years old. But anyway, it basically tells what happened to the cash. And it's become a very important statement. And if you want to finance or areas like that, it's big. So that's what we're going to learn how to do today. Now, there are some quirks to it. And I'm going to show you the indirect method. And the indirect method is it's probably the most intuitive and probably I think one of the more useful of the method. Okay, so it's kind of a formula here, and we'll follow this formula. You'll see how we work this formula as we go through. But we have this operating cash flows. This is the first section. I'm going to call this section 1. Second section is the investing one. And the third one is the financing. Okay, the first part of the operating one, this comes from the income statement. Same income statement we talked about before. It's a net income, depreciation, we'll talk about gains and losses, we'll talk about those. The second one here comes from the balance sheet. Oops, that's nice about balance sheet. And this is what we call current assets, which we haven't talked about. And current assets are generally assets of 1 year or less. Oops. And these are the things you generally see in the current assets. You'll see accounts receivable, inventory, prepaid items we haven't talked about, trading securities we haven't talked about, but yeah, we'll talk about those as we go along. The second part down here is also the balance sheet, but instead of current assets, current liabilities. And payables are usually what we talk about there. We'll talk about some of these other things, but the big one is payables. All right, so this is what we're going to start out with, this operating cash flows, and this is the one that we're going to, this is probably the hardest of them. Okay. So coming over here, number 1, prepare the operating section of our statement of cash flows. We start out with our net income. Net income is money coming in. I think we just copy these, can't we? Okay. So net income, that's money coming in. Now, depreciation expense. This is going to sound strange. Normally, you think of an expense, you think it's negative, right? It's money going out. But let's think about depreciation for a second. People say when you buy a car, it depreciates the most the second you drive it off the lot. It's no longer a new car, now it's a used car. Okay, so let's say that the value of the car goes down by whatever, $3,000. Right? You drive the car off the lot, it goes down $3,000. Now, we would think about that in accounting as being a depreciation expense. However, notice something. It's not like you wrote a check for $3,000. No cash has gone out. So yeah, the car is worth less now after a year or 2 years or 3 years or whatever, but there's no cash going out. You know, when you drive that car off the lot and it goes down in value, you're not writing another check for that. It just went down in value. As far as the car operating and all that, it has no impact on it. So that there is no cash involved in depreciation. Now, remember back to us doing that with those income statements. Whenever we add an expense, we subtracted it to get our net income. We did the same thing here to get our net income. We subtracted out that depreciation. Now we're going to add it back because we said, look, we're just looking at the cash, and there wasn't any cash with that depreciation. So depreciation will get added back in, and you'll see that. Oops. You know, if you look over here, bold those. You notice depreciation, it's added back in. All right, so we're going to add that back in. Okay. Coming down here, these first two, space these out. These are current assets. Okay, so as accounts receivable increased and prepaid expenses. Prepaid expenses are things you pay ahead of time and they have a value that, for instance, if you prepay insurance, you know, for the next year, say, you have the benefit of that insurance for the next year. If you, or if you cancel the insurance, they have to pay you whatever's remaining on the insurance. So you still have this asset, even though you paid it ahead of time. You still have this asset on the books that you're going to get a benefit from that insurance or get your money back from the insurance if you cancel it. So prepaid, these are both assets. Now, this is where it gets a little bit wacky. Increases in assets decrease your cash. They go in the opposite direction. So if you have an asset that increases, that means your cash decreases. Let's take the example of inventory. If you buy inventory, well, what do you buy it with? Well, eventually it's going to come out of cash. So if an asset increases, like it did here, it's going to decrease the cash flow. So assets actually go in the opposite direction. Oops. So accounts receivable, if they increase, your cash goes down as an asset. Prepaid expenses is an asset, but it decreases. It's the opposite. If it decreases, your cash goes up. And just in case you're wondering, this is the hardest part of the course. This the statement of cash flows. This is hard for senior accounting students. If you're not a accounting student, if you weren't in the past, this is rough. By the way, I did the same thing. When I went to my master's program, I switched over to accounting. But assets go in the opposite direction. And you think about purchasing inventory. If you buy inventory, what happens to your cash? Your cash goes down. So anytime you purchase an asset, your cash goes down. If you get rid of an asset or sell an asset, your cash goes up. Okay, down here, these are current liabilities. What do I do here? Okay, current liabilities. Now, liabilities, you'll notice that they go in the same direction Oops, that's not one. You'll notice that they go in the same direction as cash. If a liability goes up, your cash goes up. Think about taking out a loan. If you take out a loan, yeah, you owe more liabilities, but you got more cash. How do you decrease your liabilities? You pay them off. So if the liability decreases, your cash decreases. So these go in the same direction. Oops, what I do? Did something wrong here. Okay, accounts payable decrease, so our cash must have decreased. We must have paid off those accounts payable. Accrued expenses, I haven't talked about those. Probably should do that. They're also a liability, and they also went down, so your cash goes down. So these go in the same direction. Assets go in opposite, liabilities go in the same. So opposite direction for assets, same direction for liabilities. Oh, what are accrued expenses? Accruals are just things that haven't been paid yet. Truthfully, an accounts payable is an accrued liability. So accruals, the way we use it in accounting, they just haven't been paid yet. And an accrual is, a liability is basically an accrual. Even though we call them payables, it's what they would call it accrual. That the cash hasn't changed hands yet. The transaction has. You purchased something along those lines. Now, accrued liabilities are usually things like payroll, stuff that you owe to employees. Now, notice that unlike a liability, no one's going to hand you a bill. Your employees don't hand you bills usually. But you still owe them, when they work, whatever, how many hours they work, you owe them for those hours that are work, and that's an accrued liability. So how does that go down? Well, you pay the employees. What do you pay them with? You pay them with cash. So that's why these accrued liabilities are the same things as payables, and that's why they go in the same direction as cash. Okay, so we add all these up, and this would be the operating section. So this would be the net operating cash flows. And by the way, it's fairly common to have cash flows higher than the income. In fact, you can even have that if they have a loss, you can have a loss of net loss instead of net income and still have positive cash flows. Any questions? All right, let's do another one. Let's see here. Operating section. Okay, so we basically start out the same. Okay. All right, so we're gonna do the same thing. And again, we're gonna kind of felt, you know what, I'm gonna move this down. 1 second. Oh, you know what I could do? We could split the screen. Oops. Wrong. uh, All right. I don't want to do it. Okay, so let's go ahead and do this one though. Okay, operating section. So we start out with our net income. So these are basically the ones we're gonna use first. So net income, we got here. Depreciation expense. And again, we subtracted out that 6,120 to get our net income, but there wasn't any cash. We didn't pay cash for any of that. Kind of, sometimes you hear about paper losses, that's what depreciation is. Okay, now comes for the weird one. Gain on sale of equipment. Okay, this gets subtracted, and I'll tell you why in a second. If you look over here, you see they subtract out gains. You say, well, why do you subtract out gains? You know, why is that? Well, basically gains come from sales of long-term assets, and we don't know this yet, but down here for the investing cash flows, this is where we deal with long-term assets. So we're basically taking it out of this current asset category and moving it down here to the investing cash flow, which we'll talk about like 5-10 minutes. So kind of like think opposite day when it comes to gains and losses. Gains get subtracted, losses get added. Okay, let's see here. We got to find our current assets. And these are the new ones, so. All right, accounts receivable is a current asset. Inventory is a current asset. So we expect that we're going to collect these accounts receivable within a year. Inventory, you usually expect to sell within 1 year. Accounts receivable decreased, so that means our cash goes up. Goes in the opposite direction. And if you think about it, if our accounts receivable decreased, that means more people paid us, so our cash went up. Inventory decreased, same thing. It's an asset going down, so our cash goes up. If an inventory decreased, that means you sold it. So assets go in the opposite direction. Current liabilities, they go in the same direction. And liabilities are accounts payable. Accounts payable increased, so our cash increased. We go in the same direction, liabilities. Taxes payable decrease. Some weird spacing there. Not sure why I did that. Okay, taxes payable decrease. Well, the only way those decrease is if you pay them. So our cash goes down. I think that's all of them. Yep. All right. So this is our Net operating cash flows. 14,000. This one's a little unusual. They have this big lump payout of taxes for some reason. Okay. These next two. Oops. Get enough of them. These next two are exactly the same thing, but we have to figure out whether they're increasing or decreasing. Okay, everything starts out the same. Net income. Money coming in. Depreciation expense. It's added. Here's a new one. Loss on sale of investment. Now, you'll notice that the losses get added in because we're undoing it. These losses are going to be in this other section, this investing section down here, which we haven't talked about yet. So the loss on investment will actually get added in like opposite day. Okay, teach you how to be lazy. Current assets. Copy and paste. Our current asset we have is our accounts receivable. Now it went from 10,000 in 2021 to 11,600 in 2022. Increase or decrease? Was that an increase or a decrease? From 10,000 to 11,600.
It increased.
Yep. It increased by I should do this a little differently. So it increased, and it increased by 1,600. Okay, so it's an asset. It increased. What happened to our cash? Go up or down?
Decreased.
Yep. So accounts receivable went up. And if you think about it, what that basically means, if accounts receivable goes up, that means people haven't paid you. You know, they haven't paid you 1,600 more. And we're gonna do the same thing down here. Accounts payable. Accounts payable also increased. Same amount? Nope. Okay, so. Now, accounts payable increasing, that means it's kind of like borrowing more money. You didn't pay for $1,200 of it. So your cash is actually going up. Hey, in some. So 32,400. And our last of the operating cash flows. Same thing as before. Oh, we have something new here, amortization expense. I guess I threw a bunch of wacky stuff in this one. All right. So net income, same as before. Depreciation expense is the same as before. It's added back in because we really didn't pay this amount. All right, amortization expense is very similar to depreciation. Amortization is when you do something, you decrease the value of an intangible, like a copyright or a patent or something like that. And so that will, again, there's no cash goes up. Excuse me. All right. So both amortization and depreciation, there's no cash involved in those two. Okay, the wacky one, gain on sale. It's wacky because a gain usually think of as a plus, but in this case, it's going to be minus. Okay. Oops, let's split these up. Okay, inventory is an asset. And it is going down, right? So it decreased by 400. Inventory, when it decreases, that's sort of like it's an asset going down and you must have sold it. So your cash must have gone up. Accrued taxes, again, this is accrued just means like it's like taxes payable. So what you owe the government. And accrued taxes decreased. Oops. And for liabilities, the only way liabilities go down is if you pay them. Yeah, let's calculate. Okay, so accrued taxes decrease. So a decrease will also decrease your cash. How do your current liabilities go down? When you pay them. The operating cash flow is 46,000. Again, it's not unusual if they have a cash flow higher than the income because of the depreciation usually. But that's fairly common. And what that tells you is you can still have money coming in even though you maybe are losing money when it looks like your income. You can actually have a positive cash flow coming in, and that's what you pay people with. Okay. Something here. Okay, investing cash flows. This is whenever you buy or sell a long-term asset. So this is only for long-term assets. And buying or selling. When you sell something, your cash goes up. When you buy something, your cash goes down. So it's sort of like the kind of like back up here for the current assets, you know, if they go up, cash goes down, same thing. So if you sell a building, your cash goes up. If you buy a building, your cash goes down. You know, I'm just gonna do these on the side here. Yeah, I mean, you can't put them, I guess you can put it on everyone. I'm just gonna do them over here. I don't know what I was thinking when I wrote this one. Acquired of plant assets. Let's just change that to acquired plant assets. How about acquired plant assets for 58,000? Now acquired means you bought it. Is our cash going to go up or down?
Down.
Oops. Okay, sold land with a book value of $10,000. So we paid $10,000 for the land, but we had a $2,400 gain. This is kind of like what we're talking about up here. And we have a gain, you know, down. So we're going to have this gain. We're not going to ignore the gain. We're just going to put it into this, this down here. All right. How much cash did they get?
$12,400.
Yep. And that is money coming in, so that'll be a plus. Sold. Ignore this one. This one's out of date anyways. Well, no, it's not out of date. There still are trading securities. They're just not very common anymore. However, trading securities go in the operating section. They're short term. We don't do anything with these. These are, I was gonna put NA. It's not, it's in the wrong section. Available for sale investments with a carry value of 17,000. Now these we are going to put in the section. Were sold for $16,100 cash. Okay. So how much cash do we get? It's so easy, no one wants to say it, but yeah, 16,000, if we got 16,100 cash, that's how much cash we get. Now, it's true that we had a loss here, but that really doesn't matter. You can take 17,000 minus, what is it, 900 loss, and you get the same number. Okay, so. I'm just gonna add these up. So this will be our. Our net investing cash flow. So investing is, the thing about investing is for long term. Okay, now here's kind of the wacky thing. Normally you think of cash flow, you say, oh, well, negative is bad, right? Negative cash flow is bad because it's money going out. For the investing section, here's the wacky thing about the investing section. The investing section, you want it to be negative. Why? Because it shows a company that's growing. A company that's growing will be buying assets. They'll be buying buildings and equipment and all that kind of stuff. So if they're growing, or even if they're staying the same size, they still have to replace equipment and all that kind of stuff. So you want that to actually be negative. If it goes the other way, if it's positive, that's a company that's shrinking. They're selling off their assets. Sometimes there's a good reason for that, but it's generally a company that's going down. So sort of a healthy company, you want to have a negative cash flow for investing. It shows that they're investing in the future. Okay. We don't need to bring all this down. Let's bring section D down. I did something wrong here. What did I do? Okay, so same thing coming down here. Purchased equipment for 900. What happened to our cash, up or down?
Have a loss.
Yep. Good. So this will be cash going down, right? They when you purchase something, your cash goes down. Sold equipment that cost $5,000. It had accumulated depreciation, so they depreciated it by 3,300. We sold it for $2,200 cash. So what's that one going to be?
Positive 2,200.
Yep. Yeah. So let's look at the cash. And all this other stuff doesn't really matter if you look at the statement of cash flow. I mean, yeah, it happened, but statement of cash flow, you're just looking at the cash. Purchased investments for 7,000.
Yeah.
And again, this is kind of what we want to see. We want to see negative cash flows for the investing, because that means the company is either growing or staying the same size, and that looks like what's happening here, so. That's, even though it's negative, that's actually good. Okay. Financing section. Oh, I left this thing up here. Okay, financing. This is long-term liabilities. And equity, which is basically stock, usually. Okay. So financing. If you have an increase in any of these bonds payable, long-term liability, mortgage payable, obviously, a long-term note payable. Just like for this up here, with the current liabilities, if they increase, your cash increases. So if you borrow money from the bank, you get a mortgage, you borrow money on a mortgage, your cash goes up. Now you have a higher mortgage, but your cash, when you borrow it, at first it goes up. Bonds payable are basically the same thing as mortgage payable are. I don't know if you guys know. What are bonds? Bonds are like little mini loans. And they talk about selling bonds. If you sell a bond to somebody, you're actually borrowing money from them. So a bond is like a mini loan. Now you say, well, okay, well, so why don't you have mini loans? Well, here's why. If you need to borrow a whole bunch of money, let's say that if you buy like a $300,000 house, you probably go to a bank and get a mortgage. If you want to build a $300 million factory, you probably can't go to one bank for that. So what they do, and now $300 million factories get built every day. So here's what they do. They take that $300 million that they need and they chop it up into little segments they call bonds. They say, okay, well, instead of having, one big loan that we need, we chop it up into a bunch of little loans, and those little loans are bonds. And when they talk about selling it, what they're really doing is borrowing money. So if someone buys a bond from you for $1,000, you give them the bond. That's the piece of paper that says we have to pay you back. They give you the $1,000. What you've really done is borrowed $1,000. So bonds are the same thing about it. It's just when you take a big loan that you probably couldn't get anyone to take and making it into small chunks. And a bank might buy those bonds. The bank might say, okay, yeah, well, we can't give you, 300 million, but we can buy 5 million of these bonds. We can loan you $5 million. And then another bank will do the same thing, and so on and so forth. So that's what a bond is. Now, decreases when you pay off your liability. Sometimes these are called retirements when it comes to bonds. They talk about retiring a bond. Retiring a bond is when you pay it off. All right, so let's go down. Begin. What in the world I'm doing here? Did you guys notice that? I've noticed that. Okay, so coming over here, and I think I'm just gonna do it on the side for this one too. Oh wait, I got it right here. All right. So stock. If you sell stock or issue stock, your cash goes up. And again, if you purchase it, retirements of stock, it goes down. Cash dividends paid always goes down. All right. So let's look at these. See whether they're pluses or minuses. Payment of dividends. Plus or minus? Keyword payment. Your cash going up or down?
Down.
Yep, very good. So this will be. Sold treasury stock. So we had some stock that we sold.
Let's go up.
Okay, now here is where the terminology is a little bit wacky. Issuance of stock. Issuance is the same thing as selling stock. When they talk about that they issued stock, that means that they sold it. So same thing as sold treasury stock. This is sold common stock. It would be the
Okay, same thing, go up.
Yep. Issued a notes payable. So it's a liability
Mhm.
and it's going up. So what happens to your cash?
Your cash goes down.
Actually, it's gonna go up. Initially, it's gonna go up. Now, when we pay it off, it'll go down, but when we first get the note payable, we go to the bank, we sign the note. They'll give us $11,000 for our cash, but you know, I realize this isn't gonna, work, is it? Oh, I get it, if I do it here, I use it. Okay, so this is our. Net financing cash flow. And this, you generally want to see this going up. Because this is when you're borrowing money to. Here's how these two sections are kind of similar. Generally, you do financing to use financing to fund this investing section. You know, this is long-term liabilities. Ownership is long-term, is forever, basically. And you're investing in long-term assets. So this is kind of how you do the funding. If you want to build a factory, you know, big investment over here in a factory, okay, you know, sell bonds or sell stock or something to get those big dollars for making this. Okay. Last one. So last one. And oh, you know what I realized? I had these all copied down ahead of time. What was I doing? I was being silly there. I just I noticed on the last one, and I made this thing. All right. So issuance of bonds. You plus or minus? Well, issued is the same thing as a sale. So you come over here, you know, issue is a sale, same thing for a stock. If it was a stock, it'd be the same thing. Whenever you say they say issue, I don't know why they say issuance. I guess because it's a security. But anyway, so issuance is a sale, so this would make our cash would go up. Retired bonds payable. So remember, bonds are like little loans. So what's the only way you make loans go away? By paying them.
Pay them off.
Hey, how come that one's not centered? Repayment of short-term loan. Up or down for cash?
Would it go down?
Yep.
Because we're paying down on it.
Right. Yeah, so liability is gonna, the only way that they. When they go down, the only way they go down is by. Paying out cash. Okay, we purchased treasury stock. Now notice that purchases. Purchase of retirements, this means you buy it back, or in this case, you're buying it back, but it could also mean you buy whatever you, whenever you see purchase, your cash is going down. So this would be a negative. Okay, and this is net financing cash flows. Oops. And that's negative. This is actually a bad thing. This is when a company's shrinking. Because usually to pay off this stuff, they're selling assets. Now, there might be a good reason why they're doing it, maybe whatever it is, they're getting out of a certain market or something, but generally you want to see the financing section to be positive and the investing section to be negative. That's usually the way it goes. And if those are reversed, that means the company's shrinking. Okay, we're going to put those all together in a statement over here. But let's take a break. You can take a picture of that, or you got it? Okay, let's go over here and let's say be back at what time was it? 7:03. All right, so you'll be back at 7:14, I guess. And we'll do this one. This is similar to what you have in the book. We put these all together. Maybe if we have time, maybe we'll just go ahead and do the book one. Chapter 4 isn't too hard. This is harder than chapter 4, I would say. All right, let's go ahead and take a break.
Cash. 215 was 840 cash. Mhm. Hmm. 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 Mhm. Hmm.
Okay, let's see here. So this one's gonna be similar to what you have in your. Okay, so we're gonna do operating cash flows. Okay, yeah. And similar to what you have in your book here, I would never do this to you guys, but they're gonna make us calculate the net income and depreciation expense. Okay, well, we need to have both of those for our operating cash flows, so let's do the bad things first. Net income. Okay. You have to back into it from the retained earnings. So remember how we have our beginning retained earnings. Oops. So here's the ending retained earnings from 2021. That'll be the beginning for the next year. Then we have our net income, which we don't know what that is yet. I'll put a question mark there for now. Subtract out our dividends paid. Ah. And this will equal our ending retained earnings is that. So what we have to do is come up with what our net income is. You could do this mathematically. You could also do a kind of reason through it. Mathematically, it looked like this. So 800 plus, we'll say X for the amount of the net income minus 360 equals, oops. So if you solve for X, okay, so if you add 360 to each side, ooh, don't do that, Mark. Stupid. Okay, so X, let's see, if we add 360 to each side, it'll look like this. This 360 will disappear. If we subtract 7,800 from each side, this positive 7,800 will disappear. So whatever those are. I'm sorry, 1260. And let's see if that actually works. Oops. Yep, it does. Okay. So this is our net income. Our net income is 1260. Depreciation expense is actually a little bit easier. So this is a tough one. We got that. Depreciation expense. Notice that our depreciation of this machinery went up by $345. So that will be the depreciation expense. We now have 300, this year we have $345 more of depreciation. I think the book, I think they actually give you the depreciation expense. Maybe they don't. I'll have to look at it. But anyway, that's how you get it. You look at the accumulated depreciation. Okay. Now, do this. Okay, so we start out with our net income. Sure, why I have two columns here. Go to our depreciation expense. Oops. Did something wrong here. Oh. Okay, let's see, we need our current assets. Oh, I know I have those. Okay, the accounts receivable increased. And our inventory decreased. Okay. So. So this is an asset that increased, so what happens to our cash?
Increase? Did it increase?
It'll actually decrease. So current asset, so asset, this is an asset. You know, I should put that right. So asset, they increase, your cash goes down, kind of like, think about inventory, if you buy inventory. You know, your inventory goes up and your cash goes down. By the way, if this stuff looks like it's from Mars, it should. This is probably the first time you've seen it. Or if you saw it, maybe you saw it a while ago. Okay, inventory. Inventory decreased. So decrease in inventory means you must have sold it. So that'd be a plus or just think of that. Plus or minus.
A plus.
Yep. Okay. You sold it, cash goes up. Okay. Accounts payable. We give them a different shade. Well, here.
Excuse me, so where'd you get the 1260 from? Up top, when they come at net income?
Yeah, that's this thing. That's down here.
Oh, okay, all right.
No, and they're gonna make you calculate that for in the homework problem. I wish they did. I always hate that when they have the missing number, you know. You never see that in real life. But anyway. You know, you take your bank statements to the bank. Where's the net income? Oh, you have to calculate. All right. They do that kind of stuff on it. You take the CPA exam if you're looking to get into accounting and you want to take the CPA exam, they'll do that kind of stuff. Again, very rarely, I think, does that actually happen. Something really wacky is going on. Okay, so accounts payable is a liability. Now, this one down here is long-term, so this is not gonna be in the operating section, but this is, so this will be, I'm gonna do it decreased. Okay, so accounts payable. Let me, before I do anything, let me label that, that's a liability. Accounts payable is a liability, and decreased. So what's the only way that your liabilities decrease?
If you pay them,
So this will be a negative. So assets go in the opposite direction. Ooh, inventory is an asset. Put that in there. So assets go in the opposite direction. If they increase, cash goes down. If they decrease, cash goes up. Liabilities go in the same direction. If they decrease, cash decreases. If they increase, cash increases.
I have a quick question.
Yeah.
The directions that you're talking about, like the opposite and same, is that only for the operating cash flow, or is that pertain to like everything moving forward?
That's everything moving. That's everything. Yeah.
Okay.
So for instance, yeah, so if your long-term assets go up, your cash goes down. I think we do that here. Don't we? Let's see here. Yeah, we're gonna actually do that. Yeah. Yep.
Okay, thank you.
For it goes same for long-term assets and long-term liability. All right, so
Okay.
oh, I missed one. Hold on a second. You know what? I'm not done here. Prepaid rent is an asset. I missed that. Sneak that one in. Okay, prepaid rent is an asset. It went down, it decreased. And again, this is an asset, so it's going to go in the, I think I can just copy this down. Hey, woohoo. It decreased, so the cash goes up. So that was rent you paid ahead of time. So in other words, you get out of paying cash this year anyways of $450 of rent in cash. All right, now I better check this to be sure I didn't miss anything else. Okay, no sales of machinery, so we don't have any gains or losses on sales. Okay. So our operating cash flows are $1,080. Okay, now investing. I gotta get rid of this. Investing cash flows. So this is when you invest in long-term assets or sell long-term assets. Now, coming over here, you see this machinery, and I think this is, they usually call that equipment, but I think they use machinery in the textbook, so I used to say. This is an asset. And it's going up. And let me give that a different color here. I'll make that blue. It's a little too dark. It's too light. Go back to the other one. Hardest thing about accounting is getting the right background color for them. There we go. Okay, so this machinery, it went from 11,000 to 14,000, so it increased. So what happened with the cash? Did it go up or down? We got more assets now. You can go up here and look and see what happens. So this went this
Come
increased.
down.
Yeah, so this went up, so we must have paid another $3,000 for. Oops, listen to that. And this is what we want to see actually in the investing section. We want it to be negative. I know that sounds kind of funny, but you know, we got auto sum here. I guess that's they got one thing, but okay, financing cash flows. So we're looking down here now. Let's make that orange. And orange is too close to the red. Let's try something else. Let's make a kind of turquoise-ish. Okay, we're gonna do that. Okay, so let's take long-term debt. Now, this is a liability, just like the one above it. It's a long-term liability, but the liability rule is still there my cat's barking upstairs again. All right, so the long-term liability increased. Okay, so what happened to the cash? So it's a liability and it increased. So we borrowed some more money. We borrowed $1,730 more.
So it increased.
Yep. And again, this is you know, when those things increase, the cash goes up. Now, eventually you're going to pay it off, and your cash will go down when you pay it off. But initially, it'll go up. Okay, and common stock also increased, right? So we must have sold more stock. We sold $1,000 more stock, so it will also go. This is actually an equity account. And there's one that I should say I always miss. There's one that I always miss that goes in here. It's this one. Cash dividends paid. I don't know why, but it always slips my mind usually when I go through these, so. Cash dividends paid, and whenever we pay dividends, our cash goes. Let's make that one blue too. Okay, so net financing cash flows are. Okay, now. what we're going to do now is take all three of these. Hey. Ah. And we're going to add these up. And these are going to be the net cash flows. Okay, now okay, well, that's the net cash flows, cash flows, okay. So what? Actually, it relates to this up here. Notice our cash went from 2,700 to 3,150. So this will be our our beginning cash will be 2,700. Our ending cash, if we add these two together, it should come out to that 31, and I think it does. So what we've kind of explained when we did this, give me a second, is we said, okay, cash went up by 450. Okay, our beginning cash was 2,700. It went up by 450. The ending cash is that. That's exactly what we expected it to be. So you can actually kind of check your answer when you do these, because the net cash flows plus the beginning should equal the ending. And that's not how you spell beginning. That's how you spell it. Okay. So our beginning cash was 2,700, our ending is that, and this explains, this statement of cash flow explains how we got there. So, okay, well, this is how much came in from operating. Positive, that's good. Investing cash flows, negative, also good. Net financing, positive, also good. And so that's how we got these cash. We explained how it went from 2,700 to 3,150. Question on that? The real pain is this in here. This is the problem in here. This is the yucky. It's, getting this stuff, and however you want to do it. And, the finding the net income, you can even just like play around with numbers until it comes out to be the same. But anyway, yeah, coming up with these is the, now you do have this spreadsheet though, so you can use this when you take the test, I'll take the test or do them. Question on that? This is by far, I think, the hardest of the chapters. It's hard all the way up in I had a professor who had 2 PhDs. He had a PhD in Sanskrit and a PhD in accounting. He took the CPA exam. He had a statement of cash flows and said, "I couldn't get it to balance. It was off by $10." He said, and I finished the test early. I sat and stared at it for a half hour. I never figured it out. Turned it, he passed the exam, but you need like 75% to pass CPA. But you get someone with 2 PhDs who's staring at this thing for a half hour and not figuring it out. It can be tricky. Okay, how about, are you guys up for doing the the next handout? I'll tell you about the next handout, and then this one shouldn't take long. Okay. Ratios. So this is chapter 4. This is ratios. And ratios, a few things about ratios. The idea is that there are relationships between numbers on the financial statement. And that those relationships, you can use those to see how well the company's doing. So ratios, what do they use them for? Analyzing the business. Trying to help identify trends that are good or bad in a business. So what are the trends? And compare businesses that are similar. This is actually a really good one. My favorite fortune cookie saying is that there's no such thing as an ordinary cat. All cats are different in size, color, fur, and everything. So if you think about it, that there's no 2 cats that are the same, basically, and the same thing is true for business. So you have 2 companies. Let's say you have Walmart and Target, both big companies, both sell billions worth of stuff. Sometimes they sell even the same stuff, sometimes not, but they're 2 completely different companies. They have different philosophies, they have different ways of doing business, they have different everything, and they're not the same company. And so if you're going to compare, how do you compare those 2? Well, one way is by ratios. Say, okay, well, there's ratios that we can use, and we can say, okay, that there's, for instance, let's say sales to expenses. There's a ratio there. Well, you can compare that to Target, and you can compare that to, Sports Authority, or compare that to Home Depot or whatever. There's a relationship between your revenue coming in and your expenses going out. So ratios kind of help look at the relationships between the numbers, not just the numbers. Walmart is always going to make more money than, say, Foot Locker. That doesn't mean Walmart's a better company to invest in, though. It might be Foot Locker is. So you see, there's a need to kind of to figure out companies that are different sizes, especially to compare them. Okay, ratios are not standardized, and you'll notice this in textbooks that some people will have the same ratio will have a different computation than others. And analysts can use whatever ratios they want. Unlike accounting, where they tell you you have to do it this way or that way, if you're analyzing a company, you can come up with any wacky ratio you want to use. And as long as you are comfortable with it, whatever, it's fine. And there's no right way to analyze a business. So you'll get even the top, top analysts, sometimes you'll get them all saying different things. Top analysts, and they say, what do they think about, well, I already use it. So Walmart, what do you think about Walmart? Well, you'll have 5 people that say buy the stock. You'll have 2 people that say hold the stock. It's not going to do great. Don't buy any more of it, but if you already have it, hold on to it. And then you'll have 4 people that say sell it. Now we're talking about people who have PhDs from Ivy League schools usually, and how can those people look at the same data and come up with completely different conclusions? So there is no one right way to analyze a company. Obviously, those people, very smart people, are coming up with different ideas. And another thing about ratios, though, a limitation of them is, while a lot of times they can identify problems, they don't necessarily, they rarely indicate the solution. So you might say, okay, well, their sales are going down. that's bad. Okay, well, what's the solution? What do they need to do? That's not, you don't get that from the ratios usually. The ratios aren't gonna tell you what to do. So while they identify problems, okay, sales are dropping, they don't necessarily tell you what what to do going forward. So there are limitations to it. Okay. This page has all of the ratios, I believe, that you will need. I think for the entire course, I'm not positive though. But if you want to find a ratio, it's probably on the second page here. So common ratios. And I use the same formulas for these that the textbook does. And yeah, there are different ways of doing it. Okay. All we're going to do is plug in the numbers here, and this will calculate our ratios for us. So let's go to ratio problem 1. Okay. Net income minus preferred stock dividends. Preferred stock dividends are dividends paid to preferred stock shareholders. And this book says to subtract those from net income. Oftentimes you don't have preferred stock shareholders. They're kind of an odd, it's kind of an odd thing to have. So anyway, we'll get the net income. So I'm just going to equal net income is here. Maybe we can color coordinate these. Let's make income green. Okay, so net income is green. Shareholders' equity for year 1. 20,000, and we need a color for shareholders' equity. Let's make that orange. Okay, year 2, same thing. We have net income of 6,000. And shareholders' equity of that. And I'm going to talk to you about another thing about ratios. Okay, so here we got our ratios, 20% and 26%. Okay, a couple things about this one. If there's good things on top, like income or sales, that sort of thing, usually you want this ratio to be high. So good stuff on top, income, sales, assets, you want it to be high. So these, you want these to be higher. And this one went up by 6%. Another thing about ratios is it's often helpful to have more, oops, did not mess them up. It's also helpful not to, or to have more than 1 year to compare. So for instance, if you just had year 2, 26%, it might not be obvious if that's good or bad. But if you can say, okay, it went from 20% last year to 26% this year, it's an improvement. So a lot of times if you have more than 1 year, it helps. Okay, return on asset. Income. Usually you just see this as income, but this author says income plus interest expense times 1 minus the tax rate. Thankfully, we don't have any interest expense on this one, so we'll just use the net income again. over our total assets. Okay, let's make total assets. Make them blue or turquoise. Okay. Second. You know, doing these ratios to some extent, it's kind of like baking a cake or something. They tell you go get this and go get that and put it in here. Okay, return on sales, net income. Over our sales, and we need a color for sales. I think we have red, don't we? I don't think we have red yet. Nope. Okay, we'll do. So you kind of see this. It really is kind of like baking a cake. Go get this. Okay. And again, good stuff on top. Income. You want these to be higher usually. So again, if you're year 2, you know, if you looked at just need to do that. If you just looked at year 2 and said 15%, it may not mean too much. But if you know that year 1 was 9%, like okay, now we're doing better. We did better in the following year. I am going to copy this down here just to keep them close by. Okay, coming down here, net sales. That. For total assets, we had those two somewhere. So asset turnover, you want this to be high. It went down a little bit, but not too much. A little bit it went down. And again, if you just looked at one of these, it may not be too meaningful, but if you look at both of them, it's about the same. Financial leverage. Oh, what am I doing? I'm messing things up. That's what I'm doing. Total assets. And shareholders' equity. Let's go. This one's a little bit of a mixed bag. It's hard to know whether this one should go up or down. Now, assets on top means you want this to be higher. Usually, it's usually a more secure company if it's higher. They drop down. But here's the wacky thing about this whole assets to equity thing. So while it does show the company's gotten riskier companies are generally more profitable. It's hard to have a nice, safe, secure company that's very profitable. Usually they're a little more risky. So even though it increases the risk, sometimes companies do that to increase the income, increase the profitability. Okay, now let's go to the next one. All right. Liquidity ratios. This is basically how much can you know, how can you pay your debt? Okay, so if we had to pay off, or excuse me, cash market securities to total assets. Oh, cash to total. How much of your assets are cash? So cash plus marketable securities. And you divide that by total assets. Marketable securities are like we buy in stocks and bonds. And the reason why those are very close to cash. You can, call up the brokerage firm and sell those within minutes. All right, so our cash is 24% of our assets in year one. It's 20% in year two, so that's a decrease. And you usually want that to, well, if you increase it, it's safer. If you decrease it, it's probably more profitable. Okay. Cash plus marketable securities plus accounts receivable. You can actually take your accounts receivable and go to the bank and get them and sell them to the bank, get cash for them. Now, this is a little bit unusual in that it looks like these are all the current liability or all the current assets. So if those three are the current assets, you can just use this number down here. If all of these are the same ones. Yeah, it looks like they are. Yeah. Wait a minute. Are they? Maybe not. No, they're not. Ooh, that's tricky. See that? That's why we do this. Okay, we cannot do that. All right, so what we're going to do is do all three of these. So a quick ratio is if you had to get money quick, how could and pay off your current liabilities. How much of the current liabilities could you pay off? And be here. And you'll notice in the second year, you can pay off more of them. You want this to be high. It's safer if it's high. Okay, and current assets. My current liabilities. Okay. Long-term debt to total assets. This is also an unusual one in that the author says to put the long-term assets plus the current portion of long-term assets. So this is actually a current liability. These are long-term, but they're saying use both of them. So the current portion of a long-term debt, certainly let's say you have a mortgage. And the mortgage is for 30 years. Okay. The stuff you're going to pay off in the next year is current. That's current within 1 year. You're going to be paying off your monthly mortgage for the next 12 months for the next year. The other 29 years are long-term. So if you get a mortgage and you're paying it off, as you go along, the next year is current, because you have to come up with next year to pay the mortgage. And then the other 29 years is all long-term. Now they're telling us to add those two together. In other words, the total amount of whatever the long-term liability is. So we're going to add both those together. All right. Oops. Total assets we already had. Yeah. Total assets column. Okay. So our debt to long-term assets, it went down. This is actually good. Liabilities are bad. So you want these to be low, and they got lower. So if there's bad stuff on top, like liabilities, you want it to be low. Okay. This one has the same thing. Long-term debt plus, and we're going to compare that to our equity section. So here's our equity section. Let's make that, I'm running out of colors here. Wait, is this one yet? I think I did. Okay, and this one got better also. You see the bad stuff on top, debt reduces it. Okay, and the last one here, net income, income before taxes plus interest. Okay, so here's before taxes plus interest. I think we're out of colors. And we'll make it that color. I'm gonna move this down. Okay. Oops. And we are going to divide this by the interest expense. And now I'm regretting using the same color for those two. So we earned our interest expense 14 times. This is like paying your interest on your loans. So about 14.75, almost 15 times. And then year two, we could pay it 16 times, so that's good. And net income on top is good. All right, that's it for that one. And again, when you're doing the homework, you can just use these, use them again, clear the numbers out, put their numbers in. And the last one. Oh, good, it's short. Oh, yeah, these are turnovers, days receivable. Okay. Net sales. Make those green. So it's like making a cake. Go get the sales. Okay, here's sales into the cake. Accounts receivable. Okay, look at accounts receivable, put those into the cake. Oops. Because it's not so easy. Click on the wrong thing. Okay, so this is how many times do your accounts receivable turn over during the year? You want this to be fast. Net sales are on the top. You'd like them to pay off their receivables as quickly as possible. So the more this turns over, the better, the easier. Now, receivable collection period, you'll notice it's 365. So that's how many days are in a year. And sales divided by accounts receivable. Well, you'll notice that that's just up here. This is just the receivable turnover is the same as that. So we can just do this. Oops. Guess we can't just do that. So this is how many days it takes to collect the accounts receivable. Year one, it took 37 days, 37 and a half days. And year two, it's down to 34 and a half. So that's good. You're getting money quicker. Okay, coming down here, cost of goods sold. Baking a cake, go get cost of goods sold, okay. Divided by inventory. Corporate inventory. Not sure why I made those both the same, but maybe they did that in the problem. Anyway. This one's a little bit odd. You want this to be, you want this turnover to be high. I put it this way, you always want turnovers to be high. So even though this one cost of goods sold really isn't something you want, as money going out, the turnover you want it to be high, so you actually want this to be high. It's kind of an exception to the rules. And then just like the one up above, find out how many days worth of inventory you have. We'll just. Oops. Oh, don't do that. I was teaching you guys what not to do. And this is how long the inventory stays on your shelf. So this, in this case, it went from 26 days, about 26 to about 25. Got a little bit better. You know, ideally you want this to turn over quickly. And that's a pretty quick turnover though. And hey, we're done. And I went over 50. Okay, you know, we got a screenshot of that. And again, you know, doing the homework, you just plug in the numbers into here. Or whatever they ask you for. Okay, and it's you can put that in Blackboard. And again, in Blackboard, if your grades are sinking, if you go into that My Business course link and click on this, you just have to click on it once and it'll sync up the grades. You don't have to use it every time, you know, so just click on it once and sync the grades up. And if you guys want to do another course, you know, you're going to do another session and do some of the homework problems, I have no problem doing that either. The only time I can't do it is Thursday. I can do it, but I can do it Wednesday, Monday, Friday, Saturday. But anyway, so if you're doing the problems, you want, you know, you want to have a Zoom meeting for that, I have no problem. So just let me know when, and I'll send out an email to everybody. Any questions?
Yeah, so when we do the homework and when we flag a question, does it go to you?
I don't know. It's a good question. Oops. Okay. So you go to course content, chapter 1, let's say. All right. See if you have any flag question.
Yeah, because I flag a question, so I don't know who would get the question. I don't know if you get it, someone else get it.
I think it just goes back to you. I think it just flags it for you. But you just go back to it. And, and by the way, I give you 5 attempts on these. If you need more, let me know.
Okay.
But it's just an arbitrary, I don't know why, I should probably raise that, but don't worry about, oh, I ran out of attempts. Oh, wait, you can't see my screen, can you? Darn it.
Yeah. Oh, now we can't.
Yeah, sorry about that.
Oh.
So don't worry about it if you run out of attempts. I can always reset it.
Oh, okay.
I got this shell from another, actually, last year I used, this one I used last year.
Mhm.
This is one I used, but anyway, I got it previously from somebody else who had it as just one attempt, which.
Oh, yeah, and that's the answer. That's the question I had. I had a question on that. I got stuck.
Yeah, it's but yeah, so and if you do get stuck, and again, you can go ahead and give me a, so if you want, if you look at this, you go, oh, man, I don't even know what to do with this. I'll go ahead and email me, and I will we can set up a time to go over, and I don't mind doing that at all.
And you say any day except for Thursday, right?
Yeah, except for Thursday and Tuesday.
Okay. Any particular time?
I usually do it around 6, just because that's where you get most people.
Okay.
Not always, it's, people work at night too, so it's impossible to do it for everybody, but 6 o'clock usually get most.
Okay, great. Thank you.
Right. Yeah,
So sorry.
no, go ahead.
I was just gonna say I clicked the link for the My Business course, and the finished homeworks that I've completed are not showing up in Blackboard.
Did you just do it, or did you do it earlier?
I've done it earlier, but I did it again
Okay, let me go to, so yeah.
because I didn't see it, so I just clicked every link.
Well, let's. The reason I'm not sharing is I'm gonna pull up the grades just to see.
Okay.
And what's your name?
Caitlin? Liptrap?
Yeah, it's me. Okay, now I can share my thing. I'll show you. Hopefully we'll work on this, but if it's not. It's not showing.
Is it because it's still red under the temporary because I did the 2-week trial and then I paid for it? Do you think?
Well, you paid for it?
I did end up paying for it. I just had to wait till payday, so I was trying to go through it.
But they should have it updated then.
Okay, I don't know if it automatically updates after the 2-week trial is done, maybe?
Could be, yeah. Let me, there is another thing I can do here. Let me, if I resend all of them, it might go. So success with that isn't always the way there. Yeah, it might be taking a while to get it possible. Wait, I can show that. I'm just paying attention.
Okay, I just want to make sure at least it's showing on your end.
Well, yeah, and by the way, it you will certainly get credit for the work. I may have to bring it in manually. That's fine. I've done it before. So even if there are some students that it doesn't link up with, it doesn't sync up with, it isn't like you're not going to get credit for it. You will. It'll just take a little more time because I'll just enter them manually. But I can enter them in the gradebook manually. it's better to have it sync because then it's immediate. You get your homework in, it should sync up within, an hour or so. And then you,
Okay,
but yeah, you are not gonna lose any points because it doesn't sync up.
okay.
All right,
Thank you.
any other questions? Okay, and again, if you ever want to go over the homework or something, that's fine. I'm available most nights at 6, except for Thursday. All right. Have a good evening.
Thank you, you too.
You.